Chinese cities following large-scale protests against
the rattling effects of protests in China on crypto and other markets. Recently, the crypto market has been facing the domino effect. After the crash of FTX, the crypto market has been struggling. With China being a big investor, the protests in China haven't exactly been helpful in this regard. If anything, lockdowns based on zero COVID that don't seem to be ending anytime soon have broken the camel's back in China, and this, in turn, has shaken the crypto and other markets. Young people in the urban middle class worst worry that they are now victims rather than benefactors of a state that is turning more and more oppressive is confirmed by the policy. This spontaneous protest wave is the desperate attempt of young people to stop or at least slow down this process. Whatever the case, it's possible that it's already past the point of no return. Worldwide, absolute rule has rejected the threat posed by unplanned protests, including those in Myanmar, Iran, Venezuela, and Russia. It seems unlikely that the Xi Jinping administration, which has been dutifully constructing the machinery of state control, surveillance, and repression for the past 10 years, will give in to this surge of unorganized discord. China's leader, Xi Jinping, was met with an extraordinary backlash on Monday, following the thousands of people who demonstrated against his zero-COVID plan over the weekend in cities around the country, some of whom attempted to openly demand his eviction in the streets. However, experts assert that the country is ill-equipped to handle the fallout from completely abolishing those regulations, which would probably lead to a wave of COVID-19 cases. China is already coping with a record-breaking outbreak. It reported almost 40,000 additional cases recently. 10 people were killed by a fire in the city of Urumqi last week, sparking protests across China as experts refuted claims that COVID restrictions hindered rescue efforts and prevented residents from fleeing the explosion. With the current protests going on, China now has two bad options. First, there needs to be a greater focus on eradicating COVID, which calls for further political repression and lockdowns. Even then, this choice might still fail to stop the current surge of infections given the latest variations' transmissibility. The alternative is to let go of the rope, which means to end the strict COVID-19 preventative measures. Zero COVID was the government's main policy for the most of the pandemic. The Communist Party in power has also taken satisfaction in China's relatively low rates of illness and fatality due to this policy. From Beijing to Shanghai and beyond, protesters have called for the repeal of the draconian COVID-19 rules, as well as increased freedom, and in one case, Xi's resignation. The possibility of social unrest in the second largest economy in the world has rattled global markets. Hayden Hughes, the CEO of social trading platform Alpha Impact, says that markets might be concerned that turmoil in China would lead to additional supply chain bottlenecks on a worldwide scale. Such chaos can raise interest rates and make it more difficult to control inflation. Prior to this, price declines were caused by a period of investor panic on international markets brought on by protests in China against COVID limitations. Cryptocurrency prices fell on Monday, along with Asian and U.S. stock prices. Prior to this, price declines were caused by a period of investor panic on international markets brought on by protests in China against COVID limitations. Cryptocurrency prices dropped as a result of BlockFi Inc.'s bankruptcy filing on Monday. BlockFi is the most recent cryptocurrency business to fail following FTX's swift demise. On November 28th, the price of Bitcoin abruptly dropped after a weekend of stability. At a time when COVID restrictions were sparking widespread protests in China, this pessimistic attitude is timely. Due to the growing disturbance in the East, investors appear to be adopting a risk-off mentality, which has increased demand for safe haven assets like the US dollar, bonds, and the yen. The social unrest in the second largest economy in the world has shaken global markets. The Dow declined by more than 500 points on Monday after falls in the European and Asian indexes. Investors were worried that the growing number of COVID cases and the demonstrations in China will diminish demand from one of the world's top oil consumers, causing oil prices to drop sharply. The price of U.S. oil dropped by 2.7% to $74 a barrel, marking the lowest point in almost a year. The cryptocurrency market has been on edge ever since Sam Bankman-Fried's FTX exchange and sister trading business Alameda Research crashed. The price of Bitcoin fell 3.3% at the start of the week as COVID demonstrations flare up in China. Investors are now less willing to take risks, which boosts the value of the US dollar. The second low was reached on November 19th and 21st, when the price of Bitcoin dropped by 7% to $15,443. Following this move, BTC saw a 9% increase, reaching $16,800, the fourth lower high. After 4 days of consolidation, the price of Bitcoin finally exploded at $16,000 $16,120, the midpoint of the $15,443 to $16,797 range. As long as BTC trades above this level, it is very likely that it will test the $17,188 Monday high and the $17,593 June low again. The $19,011 mark, where there have been the most transactions in the last 11 months, could be retested if the $17,593 barrier is broken. Nevertheless, if BTC can surpass $16,120 and turn $16,800 into a support level, it has a chance to rebound. Additionally, since November 9th, the relative strength index has been hitting higher lows, indicating that overall momentum is still compelling. The price of Bitcoin has fallen by over 21% so far in November, making it the symbol's worst month-to-month performance since June. Due to this year's crypto meltdown, a gauge of the top 100 digital assets has decreased by roughly 70%. The tech-heavy Nasdaq Composite shed 1.6%, while Wall Street's benchmark S&P 500 index lost 1.5% at the close. The biggest losses since November 9th, the first session after the U.S. midterm elections, undermined this month's impressive stock market advances. Before recovering to lose 1.6%, the Hong Kong Hang Seng China Enterprises Index dropped as much as 4.5%. The decline on China's CSI 300 index of equities listed in Shanghai and Shenzhen reached as high as 2.8% before it was lowered to just over 1%. The flare-up in China concerns, according to Lee Hardman, a currency strategist at MUFG, helped the U.S. dollar index trade 0.7% higher against a basket of 6 international rivals. Xi, meanwhile, doesn't want to take a chance on a public health accident that would damage his reputation. Of course, there is also the option of repressing peaceful demonstrators and maintaining the harsh approach, which China has historically used. But let's hope that a more peaceful solution is approached. Nevertheless, as long as this unrest in China continues, there remains the threat of witnessing another market crash.